Okay, good afternoon, everybody. Chris Lester here. I want to thank everybody for taking time out of their busy schedules, joining us here for a weekly chat with Chris. I'm Chris Lester. I'll be your host today. And I started conducting these weekly chats, obviously, last year when COVID hit. I wanted to be able to continue to bring information to the public and be able to share concepts and ideas. Sit back, relax, take notes. Some of this content, sometimes because I'm from the Northeast and I'm from New Jersey, I tend to speak a little fast. So I will apologize in advance. If you have questions, circle back to the advisor that invited you to the call and run the question by them. And then obviously you always have access to me. With that said, it's this collective consciousness, this sort of kindred spirit approach that we think better serves the financial community. Now, for those of you that have been on the calls in the past, especially in about the last 2 months, I've been doing a lot of deep dives on investments, right? So we've talked about stocks and bonds, and you may recall some of the themes of, do you need a milk cow, or maybe tornado watch versus tornado warning. A lot of that has sort of been a precursor to things that are going on in the environment, and actually started to spike a little bit this week. You probably heard the I word, inflation, right? So that always can send a scare into the marketplace, and then you have a terroristic attack on our gas pipelines. And we have to start to think about, when we think about diversification, traditional wisdom, maybe equities and bond holdings and the allocations that we're taught were secure. You may recall from a couple of my past presentations on the fixed income side, on the sort of the things that were, in the bond arena. I've issued caution to say, hey, we might want to look for what I call bond alternatives, or maybe let's start looking for other asset classes. So when we think of asset classes, obviously you have equities, and within equities, we have different, sectors within those equities, but we all know stocks and stock ownership, and we believe in the market. However, right, we also know what goes up can come down. And if that happens to we're too heavily exposed entering into retirement, that could have a negative consequences. But really the concern that we've had of late is because of, all the spending that the government's been talking about, that we have to start to rethink about how we save our money, or where we save our money, or maybe having multiple baskets to save our money as we proceed. So Kai-Zen is a strategy that I was introduced to about 8-9 years ago. I've done this for quite a few clients, and quite a lot of our advisors have done them for clients. And if you have a pen in your hand, I'm going to give you a couple notes to take along the way. So Kai-Zen is a strategy, right? It is a strategy that uses a section of the IRS code called 7702 and 72E. Those are IRS codes. It's been around forever, but that's a technical way of talking about cash value life insurance. We're going to talk about how cash value life insurance, if properly structured, can be used as another asset class. But before we get into a deep dive on this, I'm going to play a video here in a second. But I really want to just stress that the key here is proper design and having the resources available. And then I'll tell you some stories that I've experienced with clients personally over the last few years, to help you to make sure that if this is something that you're interested in, make sure you're dealing with somebody that understands how to do this. So without further ado, we're going to talk about and watch this video, and I'll be quiet. Hopefully, if you can't hear, please put something in chat and I'll restart it.
When it comes to retirement, executives often think investing in stocks and other investments will provide enough income to maintain their current lifestyle for the average 22-year retirement. But in most cases, this ends up not providing the means to maintain their lifestyle throughout retirement. And when they come to this realization, it's too late to do anything about it. Most highly compensated people don't start saving until their 40s, missing out on years of compounding interest. This result is a significant loss in retirement funds, and in their 40s, most are saving only about 9% of their income. So, how much should you be saving if you want to maintain your current lifestyle in retirement? 33% of your income. There's got to be another way to meet retirement goals without having to use a third of your income during your career. Well, there is. You now have a way to maintain your lifestyle during retirement. Introducing KaiZen. KaiZen is a proactive strategy that gives you access to extra money up front, providing you the potential to earn more for your retirement, protecting your future income without putting a drain on your current way of living. This strategy helps you maintain your current lifestyle in the event of a chronic illness, premature death, or inability to sufficiently save for retirement. Traditional retirement plans are typically insufficient for high-income earners. KaiZen is different because it makes use of leverage without the need for participant loans, interest payments, or personal guarantees. One of the greatest advantages of leverage is it provides an opportunity to significantly enhance your ability to save for retirement. Experts agree, when used correctly, leverage is a very powerful retirement tool. Even Forbes says you can leverage your way to a richer retirement. Here's how KaiZen uses leverage in a very different way. Your contributions are matched by the lender for the first 5 years. Then, the lender uses that as security for the additional funds for the next 5 years. The contributions are used to fund a cash accumulation life insurance policy. A minimum amount is used to purchase the death benefits, living benefits, while the majority of the cash is used to maximize your potential tax-advantaged growth. What could be better? KaiZen also has unique cash accumulation features within the policy. When a major market index like the S&P has growth, it is calculated and credited to you. Once gains are credited, they cannot decline due to market losses. This helps keep your money safe. Would you rather have this in retirement or the potential for 60 to 100% more retirement income with KaiZen? Secure your lifestyle with KaiZen. More money, more protection, more confidence.
So here we have 3 retirement risks, and we've harped on these the last couple months, right? The first is Kai-Zen strategy was created for the growth in income, and we do this and design it in a way that we're lowering and keeping the expenses as inexpensive as possible. People quite often will make an objection with absolutely no foundation as to what the hell they're saying. And we have run these tests mathematically, and we can show you that compared to traditional investment strategies, typically over the life of a contract like this is the least expensive option, right? It only requires 5 annual contributions. And the term non-qualified, that's when dealing with advisors, folks will say, well, when do I use Kai-Zen? And another strategy that we'll be talking about here shortly called LifeBridge. I typically will, in my mind, if somebody has non-qualified money, this is money that's sitting in a brokerage account or a checking account, typically you get a 1099 on, that's the type of money that we want to fund. Here's my, somebody will say to me, when does this not work? It doesn't work is if, let's say that typically cases for 50-year-old, 55-year-old, 60-year-old, somewhere around $50,000 a year for 5 years. So that means you have earmarked $250,000 off to the side that you're going to put into this plan, set it and forget it, and we'll draw income out in the latter years. Now, when it doesn't work, because what the banks and the lender have done is they have put a lien against this contract that makes sure that they get paid any money that they let you borrow before you do. So if somebody turns around and puts money in for 3 years, this is not for you, right? So don't do it. You have to have the money set aside off to the side with no desire to touch this and have it there for a, after we've started to design income plans for a 401k. It really, to me, makes a lot of sense, and we've had a lot of success. And I'll share one of those here shortly. So 5K, typically the minimum death benefit to do Kai-Zen is of $1.5 million. And then roughly, depending on the age, I just ran a case today. It was for a 35-year-old couple. Well, the premium for them was only 23 grand. Typically, the max age you could do on a strategy like this is about 62. and then it doesn't work. So at 62, it might be $60,000 a year. But that funding is there to create leverage. Your cash grows tax deferred. The growth of your cash is indexed to the market, but it's not in the market. So therefore, it's not subject to market risk. And then you're able to access your cash on a tax favored basis. This is a way to create what I call a super Roth-like IRA vehicle. So we all understand the advantage of tax-free growth. We've talked about that over the last couple of months ad nauseum. This is a way to create a strategy that can give us tax-free income, help us to make sure that we're divorcing the IRS along the way. And you're able to leverage your income with additional funds. So here's the way that I normally will explain it. You're getting a 3-to-1 match on your money. So if in my example, you put in $50,000 a year for 5 years, that's $250. Well, the bank has lent you $750. So you have $1 million going to work for you to create that tax-free income for an extended period of time into retirement. So people work for two reasons. To create a standard of living while working, and then ultimately that they're able to have enough money saved that they're able to maintain that through retirement. And remember, I'm an RICP, retirement income certified planner, and the goal is not to get to retirement, but through retirement. And then we often will say, hey, what could go wrong? Schwab says, spending 80% of your pre-retirement income is a reasonable assumption, unless you are 60 years old and haven't saved anything yet. All right, so current benefits being offered us are failing most of us. As you just saw, right, that most of us are saving if 10%, right, when statistically or mathematically speaking, we should be much higher. The issue is where do we put the money, right? We all understand risk. The question is, where do I get more money? And and if you've ever heard the expression other people's money, this is a safe, sound strategy that we can utilize and use as an asset class. Historically, though, in the past, the reason we haven't had to look at ideas like this is because if you work for a company for 30 or 40 years, they gave us that pension, that defined benefit plan. But now, what happened? Well, they got rid of them, right? And they're too expensive. And that means what took its place? The 401k, another section of the tax code. And again, I showed last week, the debt is at $28 trillion now. So today's retirement planning, if you're serious about planning for retirement, there are three major risks that could destroy everything you've worked so hard to achieve. A, market risk, right? We've seen what's happened in 2000. We've seen what's happened in 2008. We saw what happened last year with COVID. We saw what happened this week with a terrorist attack of our gas line pipelines. I don't know what's going to happen, but the market is extremely sensitive to information. Tax risk, again, 28 trillion and growing. Our government has a spending problem. If we don't start figuring out ways to divorce the IRS, all this money that you've accumulated in tax deferred vehicles could come back to not be worth as much. Now, what I say here, remember, I talked about non-qualified money. If you've already made a deal with the devil, the IRS, you've already accumulated most of your money in 401ks, then we have to start to look at other strategies that's, hey, how do I start to disarm this ticking time bomb right now while simultaneously being able to create some tax-free income on the backside? There are strategies, and like I said, one of the ones that I'm going to talk about here shortly is LifeBridge, and that is a way to use the funds and pay the taxes. The taxes owed are not additional taxes. They're just taxes that haven't been paid yet. But paying this along the way or disarming this along the way are strategies, and using properly structured, properly designed cash value life insurance is a very proven strategy that maybe you should consider. Again, you have to qualify. And then capital risk, the risk of not having enough available capital for contributions. And that's when, hey, listen, if this doesn't apply to you, either you're disqualified for health or because of age, okay. But there are people on this call or people that that should be looking at this as an alternative long-term. So if you could choose a retirement plan, what advantages would you want? If we had the holy grail of investments, right? Would we want deductibility pre-tax? Absolutely, right? Who wants to pay taxes if we don't have to, right? Then you have tax deferred growth. We have tax-free income. We have market-driven rate of return, safety, no downside, or interest rate risk. That's usually key in an investment strategy. And then you have liquidity. Can we access our funds? Cash in the event of death or illness. Nobody, thinks about or wants to pass away unexpectedly, right? That's, death. But I unfortunately am in a business where I've been in the position where I've had to deliver death claims and significant ones. And nothing makes me more proud to be able to know that we put enough life insurance on somebody to make sure that their loved ones are taken care of. And then matching funds. If we could get somebody to say, hey, everything you put in, I'll give you 3-to-1 on your money. How many times would you do that all day? Well, KaiZen offers all of these, except you can't take it as a tax deduction, right? So remember, the IRS has very strict rules that if you're going to take it as a tax deduction on the front end, you cannot have the money come to you tax-free on the back end. So all this without the typical risk. And let's think about if you've ever borrowed money before, whether it be for a car loan or whether it be for a mortgage, you have all kinds of hoops to jump through. Well, with KaiZen, you don't have that, right? You have a lender willing to give you money that's willing to use the asset that we're applying for, right, as collateral. So we don't have interest payments. We don't have loan documents to supply. We don't have credit checks, no personal guarantees, and then not even a signature on applying, because, and this is why I said the bank protects itself by they're basically on the account. They have access to the cash up front, right? Should you pass away. Let's just talk about worst case. You turn around, you put in 5 years of payment, they match you for 5 years, you have a bad day, you get hit by a bus, they lent you $250, your death benefit was $1.5 million. They're going to take the $250 that they lent you, they'll give your beneficiary the $1.25 million. That's how it works. But eventually, once you've paid off the loan, now all that is it's your asset that you now get the income tax free. If you're serious about saving for retirement, KaiZen can outperform other strategies and help protect you from those 3 biggest risks. I'm at my time. This is our CYA, our disclosures. We have to announce that. And we also put up here our contact information. But there's a lot of people on this call. If you're an advisor on this call, or if you're a client of an advisor on this call, make sure you touch base with the person that invited you to this call. These strategies work. Let me tell you about this, because I think this is important. I introduced one of my clients to this strategy 7 years ago. And during underwriting, he was a CEO of a corporation in New Jersey, and his wife was 10 years younger. We were in underwriting, right? And it still to this day, it haunts me because I can still see her. And the last image I have, I saw her out in the parking lot of my office smoking. And she passed away during underwriting. It was off the table, done, game over, right? So I don't have a crystal ball. I hope we all live a nice, healthy life, but that happens. Another client of mine, we've been funding this, right? We did a max funded life insurance contract 8 years ago when I introduced him to KaiZen 5 years ago. He's actually paying his last payment of $100,000 right now for he and his wife combined, right? I've helped him with 3 kids through college. He lost his job last year. He's now been rehired, but one of the biggest things that I was able to give him as confidence is I was able to look at his plan and go, you know what? You're fine. You're technically at 55, 56 right now, could retire right now, and you will make it to age 100. You guys have plenty of money. And it was KaiZen and the money that this is going to throw out that is absolutely giving me the confidence to be able to do that. Folks, these strategies work. They are proven. They're not for everybody. But again, it might be worth your exploration. So if you have any questions, please reach out. I wish all of you well. Have a great day, and I'll talk to you soon. Bye-bye.